Hey everyone and welcome. Today we're going to dig into something that, let's be honest, affects pretty much all of us, retirement plans. We're going to learn the language that shows us whether the funds meant to secure our future are actually healthy. So let's get right into it.
This is the big question, isn't it? You put money in for decades. Maybe your employer does too. But how do you really know that money's going to be there when you actually need it? How can you look at a plan and tell if it's in good shape?
Well, it turns out there's a specific rule book designed to answer exactly that. It's called International Accounting Standard 26, or just IAS 26. You can think of it as the secret decoder ring that makes retirement plans show their cards, so to speak, in a clear and consistent way for all of us.
Okay, so to really get this, you have to wrap your head around one core idea. IAS 26 treats a retirement plan as its own separate thing. It's not just some random line on your employer's financial statements, it's a completely distinct entity with its own story to tell. So, building on that idea, IAS 26 lays down a few ground rules. First, the plan is its own entity, and its reports are for all of us participants as a single group, not for you individually. It also works hand in hand with another standard, IAS 19, which handles the employer side of the equation. And this is important. These rules apply whether the plan is written in a formal contract or it's just a long-standing practice.
Now, here's where things get really interesting. See, not all retirement plans are built the same way. IAS 26 basically splits the entire universe of plans into two major categories, defined contribution and defined benefit. And trust me, understanding the difference between these two is the key to unlocking everything else.
First up, we've got the Defined Contribution Plan, or DC plan. The name really gives the game away. The contribution is the part that's defined, or set. You and your employer put money into this fund, and whatever that pot of money grows to, well, that's your retirement benefit. It's just like your own personal investment jar.
The other path you can go down is the Defined Benefit, or DB plan. And again, the clue is in the name. Here, the benefit is the part that's defined. The plan actually promises you a specific amount of money when you retire, all calculated by a formula, usually something involving your final salary and how many years you work there. It's way less like an investment jar and a lot more like a binding contract.
So let's just put them side by side to make this super clear. With a DC plan, what you get is whatever is in your pot at the end. With a DB plan, you get a promised, formula-based benefit. Two totally different endgames, which naturally leads us to the most important question of all. Who's on the hook if the investments do poorly? In a DC plan, that risk is 100% on you, the employee. If the market has a bad decade, your pot is smaller. Simple as that. But in a DB plan, the risk is on the plan and the employer. They made a promise and they have to deliver on that promise no matter what the market is doing. And this right here, this one difference is the absolute game changer. It's the reason their financial reports look so different.
All right, let's start with the simpler one of the two. How do you actually report on a defined contribution plan? Well, since the plan's only real obligation is to manage the money that's in the pot, the reporting is, you guessed it, pretty straightforward.
It really just boils down to this. A DC plan's report needs to show a clear statement of its net assets. It tracks the money coming in, shows how the investments did, and then reports the final value of the fund. That's pretty much the whole story. Okay, now for the more complex character in our story, the defined benefit plan. The challenge here is way bigger, because how do you create a financial report that doesn't just account for the money you have today, but also for a promise that you have to keep for decades into the future? This is the central puzzle of DB plan accounting. A simple list of assets just won't cut it, because the biggest, most important number for this kind of plan isn't an asset at all. It's this massive, long-term liability. So how on earth do you measure that?
The answer is a bit of a mouthful, but it's a super important concept, the actuarial present value of promised retirement benefits. Okay, in plain English, what this means is an actuary, a financial mathematician, calculates the giant lump sum of money the plan would need in the bank right now to be able to pay out every single promise it's made to employees for the work they've already put in. And just to make it a little more interesting, actuaries can calculate that huge number in a couple of ways. They can base it on what everyone is earning today, which is more objective, fewer guesses involved, or they can try to project what everyone's salary will be when they retire. That second way uses a lot more assumptions, but it gives a much better picture of the plan as a going concern, which is usually how its funding is figured out anyway.
Now, what's really interesting is that IAS 26 actually gives plans some flexibility in how they show us this giant promise number. There are basically three ways they can do it. Option A is the most upfront. It puts the promise right there on the main financial statement, so you can clearly see if there's a surplus or, gulp, a deficit. Option B is a bit more subtle, hiding it away in the notes. And option C just points you to a separate, detailed report from the actuary. All of them are allowed, which means you have to know where to look.
So, we've talked about how they're different. But now, IAS 26 brings both DC and DB plans back together with a set of rules that apply to everyone. There are some things that every single retirement plan report has to show you.
And the biggest, most important rule of all is this one. All of the plan's investments have to be valued at what's called fair value. For stuff like stocks and bonds that are traded every day, fair value is just the market value. What this does is it makes sure the report shows you the most realistic up-to-the-minute value of the assets that are backing the plan.
And here's the rest of that universal checklist. Every plan has to show you how its assets change during the year, lay out its accounting policies, and describe the plan itself. They also have to disclose any really big investments, and especially if any of that money is invested back into the employer's own company. And crucially, they have to tell you what their funding policy is.
That statement of changes in net assets, think of it like the plan's heartbeat for the year. It shows you the entire flow of money. Everything coming in from employers and employees, the income generated from investments, and all the money flowing back out to pay benefits and cover the plan's expenses. It's the whole financial story in one spot.
At the end of the day, all of these rules, all these definitions and disclosures, they all boil down to one single goal, which is stated right there in the standard. The whole point is to give us the information we need to see how the plan's resources stack up against its promises, not just today, but over the long haul.
So, there you have it. We've kind of pulled back the curtain on IAS 26. We know the difference between a DC plan's pot and a DB plan's promise. We know where to hunt for the really important numbers, so the final question really is for you. Now that you know the rules of the game, what's the very first thing you'd look for in your own retirement plan's report?